Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB here at AusBiz. I'm Andrew Gagan. Thanks for joining us as we wrap up this Friday and of course the week. And when we take a look at the market, certainly the S&P ASX 200, it looks as though we're going to finish flat on the week. But today, well, we've got a snapshot there of the COB 200 down just over 0.1%. So yeah, looking like we're snapping that 3-week winning streak as investors have trimmed positions ahead of the weekend on the prospect, potentially, according to Donald Trump, that the US and Iran are going to resume talks amidst the ceasefire. And so, well, that takes us to the themes of the day. So, yeah, big question mark whether those weekend talks are going to get underway. And of course, if they do, how long are they going to last for? Is that gulf between the two sides just too great to overcome in the short term at least? Petrol problems, well, they remain certainly in Australia, compounded yesterday, of course, with that fire at the Viva refinery, one of only two in Australia. And high tech, well, tech has been on the move, it is high. Significant rally there, and that of course has taken Wall Street to new record highs, both the Nasdaq and the S&P 500. But as I mentioned, those gains more muted here in Australia. Perhaps a little more realism among Australian investors at the moment, given what's going on more globally. Let's get to the sectors of the day. I mentioned tech. Let's have a look because that has been flying of late. Playing catch up, of course, because sold off heavily, particularly prior to the outbreak of the conflict in the Middle East. WiseTech, Megaport, among the best performers. Appen, also on that list. That's a new one to join. Lithium stocks, they've also been moving higher with the price of lithium. And well, perhaps what we're seeing with demand for lithium, given the significant increase in demand for electric vehicles, given the fuel crisis, we've seen that here in Australia with back orders months away as far as you're trying to get your hands on a new EV here. Turning to the top stories of the day, and Zip has zipped higher after upgrading its full-year earnings guidance after a strong third quarter. Viva Energy's Geelong refinery is at current levels 60% production of petrol capacity, 80% of diesel and aviation fuel. And the Prime Minister's saying that's not going to significantly affect, immediately at least, fuel supplies here in Australia. Paladin Energy, that's upgraded its production for the 2026 financial year. It's Langer Heinrich uranium mine in Namibia. And elsewhere, Amplitude Energy has locked in a major gas deal. And Alcoa, its US shares slid in extended trade after reported first quarter earnings and revenue that fell short of analyst expectations. The focus there, of course, very much on aluminium and those prices. Well, let's get across what we're seeing on markets more broadly with the global economy, and joined by Shane Oliver, Chief Economist at AMP. Shane, welcome back. Good to catch up with you. Let's start with what we're seeing with those risk assets and the equity market, particularly on Wall Street. New records, the Nasdaq, the S&P 500. How do you account for that momentum, and do you feel as though it's overextended?
I think it probably has gone a little bit too fast in the short term. I think we've come up from the low in just 11 days, which is a record on some measures. But I can understand why the markets have gone back up, because there's a feeling, there's confidence that we're on the off-ramp from this war, that Donald Trump is under immense political pressure to do a taco, which of course he moved towards, I guess a couple of weeks ago now, or last week. That Iran is equally under pressure, that Iran could logically say, well, we're going to give up our nukes and our ambitions on that front because we don't really need them. If you threaten us, we'll just block the Strait of Hormuz again. So I think you could argue they've got a bit of bargaining power in this as well. So my feeling is that we probably are on the off-ramp. Only thing is that it's probably not going to be smooth sailing. We're still going to see that there is a risk that the war could ramp up again. That Iran could go back to firing missiles off at ships going through the Strait, that it could get its Houthi rebels in South Yemen or wherever it is to attack shipping through going into the Red Sea. So all of these things could happen again. We've still got the lagged impact of the events so far yet to fully show up. Even if you open the Strait immediately, it's going to take a long time to get back to normal. So in that sense, there's still a bit of bad news to come, which may weigh on markets to some degree. But in a broad sense, I can sort of see why markets have gone up. It's consistent with our view that this year will be all right for shares. One thing worth noting, though, and that historically, and I think I've pointed this out a few times, the midterm election year in the US tends to see quite a lot of volatility. The average drawdown since 1950, top to bottom fall in US shares, not the beginning of the year to the end of the year, top to bottom fall at some point through the year is 17%. We did see 9% into that low in March, but that volatility typically starts around April and runs through to October. So you can say that we've come back maybe in time for that weakness to start again. I don't know for sure, but in the great scheme of things, I guess markets are basically backing Taco, that Trump will now do a pivot towards more consumer-friendly policies ahead of the midterms. But I'm not going to rule out further weakness from here because I think it's still going to be a volatile ride this year.
Well, and Shane, you talk about those lagged impacts. Are we yet to see the worst of those effects here in Australia, particularly fuel, potential shortages, inflation? How's that likely to play out, do you think?
Well, it's a process. You know, we had the war start immediately. The Strait of Hormuz was blocked, but ships were still on their way to refineries in Asia. So markets reacted immediately in terms of shares down, oil price up, but the supply shortfall hadn't really impacted. It's only really now starting to fully impact. The last ship that left the Strait of Hormuz on the 28th of February, the day before the war started, is reaching their destination. So refineries in Asia actually haven't cut back production yet. That's still ahead of them. If the ships don't start getting there pretty soon, and it's going to be hard anyway, even if the Strait does open, you're going to go through a period where they won't have new ships coming on and will have to rely on reserve releases from governments. But that can go on for a while, but I reckon if we get to, say, the end of May, then we in Australia will probably have to start rationing fuel. So I'm optimistic that maybe we can avoid that, but that is certainly a risk. The clock is ticking here. We really need to see the Strait reopen quickly, the ships to start filling up and coming out again. Otherwise, we will face rationing. But in the meantime, we are going to see a spike in inflation this quarter. I think inflation will get up to 5%. There will be a flow on to other products. People keep talking about fertiliser, plastics, paints and all those sorts of things. Fuel levies will impact as well. So that is going to be a concern. And in the meantime, we will see somewhat weaker economic activity. The debate is about how long that will continue for. Obviously, if the Strait doesn't reopen soon, then it goes on for longer. If it does reopen soon, then it's just a temporary effect. But it still leaves this period of uncertainty. And maybe that's what the Australian share market is factoring in here, because whilst the US and Japanese share markets have gone to record highs, we've only recovered just less than 70% of our fall. We're doing okay on a year-to-date basis. We actually were stronger than the US share market was. So we're similar in that sense. But in terms of recovering from the lows, we've lagged a little bit, perhaps because local investors are saying there's more threats to the Australian economy around stagflation, around a more aggressive central bank. The RBA is potentially talking about hiking again. I think they probably will. Whereas in the Fed, a hike, I think, is very unlikely. And the debate is when they start cutting and by how much. I'll bet there'll be less cuts than was thought at the start of the year.
Yep.
So that all weighs on our market to some degree.
Yeah, well, also weighing on consumer sentiment too, Shane. I mean, that has collapsed, hasn't it? I mean, is that we're going to see a big hit to consumption, do you think?
Well, the evidence would suggest that when you do see these big falls, big changes in consumer confidence, the big cycle, you can see it in that chart there, the red line is the consumer confidence index. Doesn't always pan out, but often when you see the big moves up and then down, a little while later, often with a lag, you see a fall in household consumption per capita or consumer spending per person. So I think the odds are we will see somewhat weaker consumer spending going forward, and that will weigh on economic growth. Will ultimately weigh on business investment. You can see in that chart there how much business confidence have fallen. That may be an overreaction. We don't know yet because the conditions haven't fallen as much, but it is obviously going to impact business decisions to hire to employ people and to invest in capex, and those things may take a little bit of a hit going forward as well. So I think we are going to see weaker economic conditions. My base case is not a recession, and there's been a lot of talk about that in Australia in the last week or so, and that got further fueled by the IMF comments. My base case is not recession. I think we slow down to say 1.5% growth, maybe go back into a per capita recession, but the risk of recession is quite high, and that risk goes up the longer the Strait of Hormuz effectively remains closed or limited to just a few ships.
But you're talking about higher interest rates, inflation remaining elevated, economic growth coming off. What does this mean for jobs, Shane? We did have that read on jobs yesterday, has held up, but I mean, this was really a read prior really to the outbreak of the conflict. That's
right. Sometimes you, as you go into winter, you talk about Indian summer. You get some warm days in May or early June, and then of course things weaken off. It's the same with the jobs figures. You could argue they are a lagging indicator. The unemployment rate remains historically low, the red line on that chart, and you could argue that jobs growth and hours worked, the blue and green lines, remain reasonably good. Not as strong as they were a couple of years ago, but reasonably good. And not shown there, but underemployment is also quite low. So that's good, but I doubt that reflects much of what was going on in terms of the war. The survey for that jobs report for March would have been, I think, around the second week to the middle of March, so it wasn't at the point of maximum concern. We really started to get really worried about the war as we went through into the latter part of March. So I doubt those figures reflect it yet, but evidence would suggest that you probably are going to start seeing the impact from the April figures onwards.
Glass half full or empty, Shane? Are you more optimistic or pessimistic at this point?
Well, I'm more optimistic to the extent that you can see Trump tacoing. He's been doing that. He's under immense political pressure. The betting markets now have greater than 50% chance that the Democrats will take the Senate. So I think it's about 80% chance they'll take the House. That's almost a given in midterm election years. But for the Senate, I mean, if the Democrats get the Senate, that has a huge negative impact on Republican or GOP perceptions of things, and there is a risk that Trump could be impeached, and lots of reviews will be undertaken if they get control of the House and the Senate. So that's something Trump probably wants to avoid. And I think he's desperate to avoid a situation where he's relegated to be called a loser again. And therefore he started to back down. And I think likewise Iran is under pressure to do some sort of deal. It's hard to know here how this will pan out ultimately. You could argue that Trump's tacos haven't necessarily achieved much of what he wanted. He did one a year or so ago in relation to China with 145% tariff on China. In the end, he got desperate, not China, and he backed down, and they come up with a truce, a trade truce, and it's doubtful that they've actually achieved anything. Maybe the same thing happens here in relation to Iran. But my feeling is that they are on that path towards some sort of resolution of this, at least in the short term. So that's why I lean to the view glass half full, even though it's probably going to be a rough ride from here. My natural optimism might be sort of coming to the fore here again. If you go back a few weeks ago when Trump was waxing and waning, dovish on the war, then hawkish on the war, and going to wipe out a civilization, I was probably more glass half empty at that point. But now I think you can see this taco coming through. It requires two to taco in this case, and that requires Iran. But I think we are heading in that direction. It's just there's going to be a little bit rough along the way, but ultimately probably turns out okay. Probably.
Yeah. Oh, well. Fill your glass up, Shane. Enjoy the drink. Have a great weekend.
Thank you. You too.
Shane Oliver from AMP. All right, let's now turn to stock of the day. And that was Zip. This after it upgraded its full year earnings guidance after a strong third quarter. We got the view from our experts, Adam Dawes from Shaw and Partners and Henry Jennings from Marcus Today.
I have stuck by this one through thick and thin, and it's certainly more thick than thin recently as it got down to some pretty nasty levels, but stuck with it. 15% up today. Interestingly, there is 159 million shares of Zip shorted at last count. 12 and a bit percent of zip shorted. What I was looking for in these numbers was the bad debts, which have come in pretty much as they were last time, 1.86%, which was ahead of market expectations.
I sold some clients out at $2.50 on the open today, which is fantastic.
Genius.
Yeah, it was champagne broking, I can tell you.
Yeah.
So I think any kind of pullback back to that $2.10, I think is a really good mark for it as well. Henry gave the glowing side of it. I'll give it sort of more of the other side, which the market could have really focused on, and it would have been a different story. But the active users in Australia and New Zealand, now we are the mature market versus the US, which is the growth market. But those active users were down a negative sort of it was around closer to 4%.
You've worked hard for your money all your life. Now your money needs to work hard for you. Whether you're building, transferring or drawing down, the right information makes all the difference. At Ausbiz Retire, you'll find the latest news and insights from trusted experts all in one place. Ausbiz Retire is powered by RAN, retirement income done differently.
All right, let's take a look at the best and worst in today's trade then. Given we've finished slightly down on the day, but it is those tech stocks that are leading it in, particularly Zip, at the back of an upgrade there. That's been well received by the market. Also, those lithium stocks doing well, among them Minres, IGO and Liontown. On the negative side, retail stocks remain under pressure. Temple & Webster has had a bad week. It has fallen or continued falling. Also, the gold miners off again today. Look, gold did come off, but there's a lot of profit taking going on again in the gold miners. Been very volatile, and also some of the coal miners as well. Let's take a look what's on overnight. First quarter earnings results continue stateside. Also get the trade balance out of the EU. And in the week ahead, Fed Chair designate Kevin Walsh testifies. That'll be interesting because he's yet to be confirmed by the Senate, so that's part of that process. Thursday, PMIs for Australia, also in the EU and UK on Thursday. Quarterly updates here from Viva. Well, that'll be interesting because there has been a trading halt given what's happened at the Geelong refinery. Yancoal, Rio, BHP, Northern Star and Santos on that list as well. All right, so this is where we're finishing up. On the CBO 200, looks as though we're down just over 0.1% to finish this Friday. And on the S&P ASX 200, close to 0.1% lower to be pretty much unchanged for the week. So as I mentioned there, a bit of a contrast to what we're seeing on Wall Street, which is at new record highs. Perhaps there's a greater realism here on the local market. That is the COB. Well, please join us again on Monday. Have a great weekend. Thanks for watching and listening.